But my guess is that in 10 years, 5 of the 10 largest banks in the world will be digitally native companies. So it's still very early days, and I think there's a lot of opportunity. But the base layer winner and the work we do is Bitcoin is going to be arguably the most important blockchain because it's really good at storing value, and then Ethereum because it's really the compute layer.
Something is happening in Bitcoin right now that almost nobody is fully prepared for. And Tom Lee thinks this rally could become one of the most explosive financial events of the decade. Not because retail investors are buying meme coins, but because the biggest players on Earth may quietly be positioning for a world where debt, money printing, and global liquidity are about to collide all at once. And here's the part most people are missing. The last time conditions looked like this, Bitcoin didn't just go up. It entered a phase that completely rewired the psychology of the market. But this cycle feels different. The ETF flows are different. The institutional behavior is different. Even the Federal Reserve setup is starting to look different. And according to Tom Lee, we may be approaching the exact moment where sidelined capital suddenly rushes back into crypto all at once. The question is, what do they see coming before everyone else does?
A lot of investors are surprised because the US is in the midst of a war that could be a long war, and oil prices are at record highs. And I think a lot of folks at the start of this year would said that this would have been enough to trigger a bear market or even a recession, but instead the S&P's at an all-time high, and the groups that led last year, like AI and semis, are the ones leading again. So I think it really speaks to me about the resilience of the U.S. economy and maybe the continued very weak conviction of most investors.
What makes this moment so difficult to read is that the market keeps rewarding optimism while quietly building the conditions for instability underneath the surface. Back in December, many strategists expected 2026 to resemble the previous year, volatile, emotionally exhausting, but ultimately resilient. The assumption was that markets would surge early, pause as investors tested the credibility of a new Federal Reserve regime, and then continue climbing on structural tailwinds driven by liquidity, AI expansion, and institutional capital flows. So far, that script has played out almost perfectly. The S&P pushing beyond 7,300 has reinforced the belief that the economy can absorb higher rates, geopolitical uncertainty, and slowing global growth all at once. But that confidence may also be creating complacency, because beneath the surface, several contradictions are beginning to emerge. Valuations are no longer cheap. Much of the optimism around soft landings and AI productivity has already been priced in. At the same time, oil markets are behaving strangely disconnected from what many analysts describe as a growing global petroleum shortage. Historically, energy dislocations tend to appear slowly, until suddenly they become impossible to ignore. That is where the debate becomes fascinating. Bulls argue the system is adapting better than expected. Bears argue the market is underestimating how fragile liquidity truly is. And somewhere in the middle sits the uncomfortable possibility that both sides may be right at the same time.
Well, in early December, we typically look at the year ahead and we write down what we think are the key drivers and kind of what the contours of the market would look like. So December 2025, as we were thinking about this year, we just thought this year would look a lot like 2025, which is a difficult year for markets, but ultimately very strong. But in the middle of that, we penciled in the idea that the market would test a new Fed. And therefore, we would have a sort of start to the year that would be strong. 7,300 was an aspirational number at the time because the S&P was in the 6,000s. But then we think that there'd be a pause, and then the setup would still be positive because we think there were some structural tailwinds. And so we thought we'd end the year 2026 at 7,700. So the year is tracking the way we expected, although we're a bit above 7,300 right now. But if someone asked me today, well, first of all, can the S&P make its way to 7,800 first before a drawdown? I think anything's possible. But I think what I am mindful of is that stocks were a lot cheaper at the end of March at the market lows. They're a lot less cheap now. So a lot of good news is priced in. And I still think that there is potential for turbulence in the middle of this year, and with maybe more reasons for it. One being, of course, the market testing a new Fed. But second is, I think it's still hard for me to reconcile that oil prices are not reflecting the acute shortage that's developing for petroleum products around the world. So I think that there's going to be some reconciliation maybe later this year. Penciling in my head just a quote like unknown right now, because to me, the current price of oil doesn't seem to reflect what will be the clearing price later this year, because we know inventories have been drawn down and we know there's a supply shortage and we know the straits aren't allowing normal traffic, and these are going to affect a lot of economies outside the US. And so as much as I want to take some comfort from like the futures price of oil, I actually don't think that reflects the price that's going to exist later this year. So to me, I'm going to just put it as an unknown, because for now, the market doesn't seem to be bothered by it, but it could be that there's a resolution before the shortages get too great, or the market will be surprised in a negative way. So I actually don't know.
Crypto was supposed to explode by now. That was the expectation. Instead, the market spent months frustrating both bulls and skeptics, drifting between optimism and exhaustion, while most retail investors kept waiting for the real breakout. But beneath the surface, something far more important has quietly been unfolding. The story is no longer just about token prices. It's about infrastructure, power, and who controls the future movement of money itself. At conferences like Consensus and Milken, the conversation has shifted dramatically. The loud speculation around meme coins and hype cycles is fading into the background, while institutions are focusing on something much bigger: tokenization, instant settlement, and programmable finance. Wall Street is no longer asking whether blockchain matters. Major banks, asset managers, and payment firms are now exploring how trillions of dollars in assets, from real estate to bonds to private equity, can move on-chain faster, cheaper, and continuously across a 24/7 global system. At the same time, AI is accelerating this transition in ways most people still underestimate. As autonomous systems evolve, they will likely require neutral rails for identity, settlement, and value transfer. That's where blockchain quietly becomes foundational infrastructure rather than speculation. But here's the contradiction. The same banks crypto aimed to disrupt are now entering aggressively because they see enormous profit potential in custody, settlement, and digital asset flows. Yet blockchain also enables entirely new financial networks that operate leaner, faster, and with radically lower overhead. When firms with a fraction of the employees begin generating profits rivaling the largest global banks, it signals something deeper. Efficiency itself is being repriced. That's why Bitcoin and crypto may not simply be entering another cycle. They may be entering a structural transition where major banks, sovereign capital, and AI-driven finance begin converging into a completely different monetary system.
Crypto has underperformed expectations. If someone was to look at why crypto matters today, I think there's two stories that are really central to what blockchain does really well. One is, of course, instant settlement and the ability to sort of confirm transactions quickly. And that's why Wall Street is tokenizing on the blockchain. And it's not even just a theory anymore. I was at Consensus, one of the big conferences last week in Miami. I actually spent the first part of that week at Milken. And actually both at Milken and at Consensus, the corporates, the financial institutions were all talking about how tokenization is a big unlock for their business. Because not only does it allow trading to happen 24/7, it starts to allow leverage or borrowing or monetizing non-traditional financial assets, whether it's like real estate or art, etc. So it's a real thing. And the second, of course, is AI is going to start to need a neutral way to both prove identity and to start to create transactions and to carry wallets. In fact, that's why Elon Musk kind of famously said multiple times in the last 12 months, in the future, money is just mass and energy, meaning the nature of money is essentially compute and power. That basically it's all describing blockchains. And I think the reason it's becoming a boomer story is that the banks, who are the most powerful movers of money in the world, realize they can make a lot of money moving things on blockchains. So they are kind of descending into crypto. But at the same time, blockchain is enabling the creation of new financial institutions that will compete with banks. And I think we did a presentation at Consensus highlighting this very collision. JP Morgan makes $60 billion a year, the most profitable bank in the world, with 300,000 employees. Jane Street is a firm that is newer, just moves money around, trading with a lot of quant and compute. And this year is probably going to earn $40 billion. They just reported $10 billion in profit in the first quarter with 3,000 employees. So with 1/1000th the number of employees, they're almost as profitable as JP Morgan, and they're making more money than the second, third, fourth largest banks in the world. So they're more profitable than Goldman, Morgan Stanley, Bank of America. Tether, which is a crypto native, completely digital native bank selling a stablecoin called Tether, is going to make $15 billion this year, which would rank it as the 8th most profitable bank in the world with 300 employees. So I think that what's happening with blockchain is what happened with digital media, where there were the traditional studios and then there was Netflix, or with telecom, where there was long distance and local, and then there was cellular, and that the new entrants gained a lot of power relative to incumbency because of technological innovation. And I think that's what's happening in crypto today. So it makes sense that the boomers are descending on crypto. But my guess is that in 10 years, 5 of the 10 largest banks in the world will be digitally native companies. So it's still very early days, and I think there's a lot of opportunity. But the base layer winner in the work we do is Bitcoin is going to be arguably the most important blockchain because it's really good at storing value, and then Ethereum because it's really the compute layer.